Good morning, everyone. Welcome to our Tuesday morning trading session. One moment here while I get the screen share going on. I was sitting here reading about the presidential debate last night, and I realized I haven't installed my trade manager yet, so bear with me a moment or two while I install a trade manager on the rest of my charts. Looks like we've got a relatively quiet open this morning on the NASDAQ. For those of you new in the trading room, what you're looking at here is the Diversified trading system, and I've got the Hawk Scalper here in the top left, Falcon Swing Trader top right, Eagle Trend Trader bottom left, and the Raptor on the bottom right. I'm following the NASDAQ on the main monitor here, and I've also got soybeans and crude oil open on my other monitor. But please don't be shy. If there's a market you're interested in that I'm not focusing on, just ask. I would be happy to pull it up for you. All right, so here we are, the market leaving off yesterday here around the 48.10 mark. A little bit of a rally through the Asian session, a little bit of a decline through the European session. We find ourselves right back to where we started. So it's looking a little bit like an extended range, actually. We'll see how this tries to play out here this morning. With ranges, of course, the best thing to do is to wait for the breakout, let the market get outside the range. It's still very early as well. If you want to try to catch an early move, well, it's always a little bit of a coin toss, isn't it? But here we go, we've got a soft edge buy. I'm not sure that's going to have much follow through, or quite frankly, we may just see the market continue sideways today. That would not be out of the realm of possibility. Crude oil also very sideways. Here's crude oil on the Hawk. Kind of give you that impression a little better, perhaps. So we've got a market that's trending down. No question about the overall trend. So I think we need to be a little suspicious about buy orders, but here we're, sticking to the lows at the moment. So the soft edge buy signal on the Raptor now having a little bit of follow through. The soft edge buy signal is a signal that's essentially a counter trend signal. It must always be preceded by a retest. A retest and a failure. The failure just means that the market can no longer head lower. We print a buy signal and we anticipate a rally. The hard edge, it tends to be our target. And it looks like that trade had some very nice progression to it. A little bit of follow through there. We should develop a trend change signal. We're printing a first micro-macro cross now in the Hawk. It's a high probability signal, the first micro-macro cross. The problem is covering the trade. Now, there's a couple ways you could do this. I was actually discussing this with one of the DTS owners yesterday, where is it better to run your stops according to the stop strategy? Say, place a stop here, or he was asking, he always sees me place my stops so deep. Well, I guess the correct answer is whatever you're most comfortable with, but to my way of thinking, if I'm going to risk $350 on the trade, give myself as much room as possible for this trade to work out. Now, of course, the flip side to that coin is if I place the stops right here, of course, I can get in with more contracts. So rather than try to trade a single, I could perhaps get in with at least 2, possibly 3. Which would also increase my profit. Now, because I'm running a single, I think I'm going to take a chance and try to run this one out. I haven't forgotten about yesterday's rather substantial opening gap, which is sitting above the market, which could see a rally all the way to, where was that gap? 48.50, 48.60, somewhere around there. That could be a pretty big move. Now, had I taken the trade and placed my stops here, where the ATR is showing, and I'm only using the ATR as an example, you could use any of the stop strategies really, I would have taken my profit on target. Why? Well, because of the big move up, it's very likely we're going to see some sort of reaction here. In fact, thinking about it, that may have been preferable. Just get in, grab the money, forget trying to ride out the swing. I'm not sure we're going to see any massive acceleration on the market's part. It may just continue to chip away like this. Come on, let's go. Still got that swing to deal with, that reaction. We would have easily hit our profit objective already. Uh, Good question, Paul. Paul asked, Eric, when trading the hawk, are you better to wait for the wick or the body of the candle to hit the micro line? Now, I'm assuming you're talking about a signal like the first micro-macro cross signal. In that case, it really doesn't matter. The macro pullback signal, by definition, is going to trade through the micro line because it needs to change the micro line's color. The other formations, four arrow consolidations, post consolidations, four arrow consolidation, again, by definition, is probably going to get into the micro line also. But I don't think it matters that much. I think, like I say, I focus more on the probability of the trade. Or of the signal itself. So these subsequent signals that you see printing here, they don't really, even though they're following through, they don't really fall into any of our high probability trades. Well, I think we're near yesterday's highs, if I remember correctly. Yes, right here. The highs of the morning anyways, around 48.30. And that's where we find ourselves right now. Working a possible cloud crossover signal. And maybe even a late filter entry signal. All right, now we're getting a a macro pullback signal here in the hawk. The macro pullback signal, of course, occurs when the micro line, that's this thin one, goes out of sync. So if we get a rally from here, that'll be my cue to start to get a little bit more aggressive with my stops. Come on, get up there a couple of bars. I'm really doing my best here not to tweak myself out of this trade. Especially since things are looking mildly bullish. Come on. Come on. So once we take out the high, I think we should be in pretty good shape. I don't think we'll see too much, or I'm hoping we don't see too much of a reaction on the break there. So we'll bring the stops in a little. Nuts to me. All right, I'm going to take my chances at break even. I'm not liking the double top that we have going on here around the 48.30 mark. Salish is asking, when do you do break even on a hawk trade? I like my break even trigger to be about 75% of the way to its profit objective. So when I'm running an all-in, all-out type trade, here for instance in the hawk I'm running 10 ticks, my break even trigger is at 8. And I tend to use that rule of thumb for all my break-even triggers. So whenever I figure if the market gets 3/4 of the way to its profit objective and then fails, turns around and heads the other way, I may as well take a break-even stop out. Come on, keep going. Don't stop now. The better stop placement is below this swing low. Or, better yet, take the money. Now we've essentially got a triple top. That's not good. One, two, three. You could, I suppose, start counting this as a 4-arrow consolidation. We'll see whether it continues to fire. All right, let's take a look here. Salish is asking, we just had a signal on the eagle. Is that a good signal? Great question. Okay. Again, I had this conversation yesterday with one of the DTS owners, and it's all about context on the chart. As traders, we get so focused on these last couple bars that we forget everything that's going on over here. And you need to balance what's going on here with what has been going on here. We know that markets tend to try to make trading ranges. And if a market is in a trading range, there tends to be a lot of buying toward the bottom end of the range and a lot of selling toward the top end of the trading range. The middle of the range is up for grabs. It's a balanced market. It's no man's land, really. For this reason, we look for things like tests of the extreme, breakouts, anything to give us a hint as to which way the market may be leaning. Right now, though, if you stepped back from this chart, if you got out of your chair and you walked to the other side of the office, and you looked at this chart, you would see this is a fairly balanced market with maybe a very large test of the low. It's also a trend change signal. So technically it is a good signal. However, the problem I'm having with this one is, where in the world am I going to cover the trade? I suppose you could just cover it below the bottom edge of the hard edge on the band. But there's no telling how deep the market may retrace. Why? Well, because when we're looking at it from this point of view, I haven't seen what satisfies a good retest of this low. So while it is a trend change signal, it's not perhaps as strong as some of the other trend change signals. When you get a signal like this, it's a trend change signal, you're looking at it. If it's a high probability signal, which it is, a trend change signal is a high probability signal for the eagle. Here's a trend change signal to the downside, and you see that had a reasonable progression lower. Here's a trend change signal higher. So here's another trend change signal higher. And it's reasonable to assume we're going to see the market trade up here, try to get into that gap from the other day. But when you get a high probability signal like this, now it's not so much a question, should I take the signal? We know it's a high probability signal, so the answer is yes, you should take the signal. The question now becomes, how do I want to manage this trade? If I'm uncomfortable about the trade, maybe I'll dial down the risk amount. Instead of 2%, I'll risk 1%. Maybe I'll try to risk it a little bit deeper on the stop. And sometimes there's going to be times that trade manager says, no, sorry, Eric, you can't afford it. It's out of reach. So unless you're prepared to take a trade and maybe risk it halfway of the range, that's reasonable. So it looks like it's about a $600 range. If I risk it halfways, it would be $300. That's a reasonable assumption that the market's not going to retrace more than half the range. So it's not so much, is it a quality signal? Yes, it is a quality signal. It's a little bit more a question of logistics. How are we going to set up the trade that we don't, A, get bumped out early, and B, are able to manage it into a profitable position. So let's see, was I able to, oh, I'm still in the hawk trade, hooray. I kind of wish I had taken the Raptor signal early on here. Those early signals are always a little bit of a nail biter, but look at that. You could have practically bought the market off the low of the day. Wouldn't that be something? That doesn't happen very often. But we're plodding along. We're doing okay. What are we doing? Oh, yeah. Okay, I think it's probably time for me to get a little bit more aggressive. There's a fair amount of money here now, especially for a tool like and we'll just press it really hard from here on out. Sure, sure. Salish is asking, can you explain that raptor signal that you're talking about? Absolutely. All right, so here's the market off the open. About a minute or two into the open, we produce a soft edge buy signal. The soft edge buy signal is a counter trend signal, which is why you need to be a little bit selective when you're employing this one. Because, of course, counter trend signals, by definition, are higher risk. So we've got, if you're going to trade a counter trend signal, the very first thing you need is a trend. You have to have a trend before you can have a counter trend signal. From here, the market makes this little test of the extreme pattern and the subsequent failure. In this case, the extreme is the low. This little hiccup right here tells me that the market's having trouble resuming the downtrend. So from these prices here, from around a high of 48.13, the sellers either aren't strong enough or don't think it's worth their while, but they're not wanting to sell anymore. So what happens? Well, the market makes that little bounce off of the low and then produces a buy signal. This is called a soft edge buy on the Raptor. And what we're anticipating is a retrace here to the hard edge. That's our initial target. Because what tends to happen is there tends to be some sort of reaction when the market encounters the hard edge. Therefore, that tends to be our profit objective. So we end up buying the market down here. And a couple bars later, there we go. We hit our first profit target. There's that reaction. It was short-lived, and the market goes into a cloud crossover signal. Comes out with another buy signal. Cloud crossover signal is a high probability signal on the Raptor. It occurs when the clouds cross over. So we went from a bearish band to a bullish band. And we see the market retreat into the band, and then the band bounces the market out. That's a cloud crossover signal. And then you can see we had some nice follow through from there also. So very strong move off of this opening signal. And again, I was a little bit reluctant because the market was only open for about a minute. And it was a counter trend signal. You know, you look at the overnight, there's a fair move to the downside there. It's not to say the market's going to continue to fall from at that point. But I suppose at the very least it would have been worth my while to try to scalp out with a little profit, maybe put a runner in play. It doesn't matter though. We did pretty good. I think we've still got the... sorry, I can't multitask. I think we've still got the hawk trade open? Yes, we do, and we're doing pretty well there. So I'm running a very aggressive stop strategy now. I'm not prepared to let the market move against me at all. And here we are near that 48.50 area. So we are trying to fill that gap off yesterday's open. Tony, never feel bad about taking profit. Tony writes, I normally don't mind taking my cash from a scalp and seeing the market go further, but wow, I wish I had followed you in on this hawk trade. You guys have, many of you have been in the room long enough to realize that a move like this happens maybe once a month, right? Where the market picks a direction and just plods along and never looks back, or never makes a really, really deep retracement. The rest of the month, the other 19 trading days in the month, the market goes all over the map, and very often you're better going all in, all out. So if you miss the move, don't beat yourself up. Trust me, I've been doing this for a long time. I still miss moves like this. Just be content with what you got. Tomorrow's another trading day. You finish the day in the black, that's a good day. Oh, way to go, Keith. Keith says, I'm currently up 132 ticks with that second contract taking that soft edge bounce. Love those soft edge bounces. I know, it's a very strong signal on the Raptor. And like I say, so long as you have those key components before you take that signal, namely, you have to have a trend going into it, and you have that retest, that failure, and then the signal, you can anticipate, like I say, at least a move to the hard edge. Now, occasionally, the soft edge bounce occurs very close to the hard edge. Let's see if I can find one. See, here's a little soft edge bounce lower, right? We retested the highs. The market can't go higher, produces a soft edge bounce to sell. Soft edge sell signal. Nice move lower. Let's see if I can find you one where it produces a signal a little bit closer to the hard edge. All right, this one's not bad. This one's actually a little bit fuzzy because we had a very short downtrend. Market comes up, a little bit of a retest of the low, not as substantial as we normally see, and then the market comes with a buy signal. So we've got all the components here for a soft edge buy, but if our target is the hard edge, should we still take this signal? Well, yes, we should, because it's a high probability signal, right? We're trading probabilities here. When the signal tends to develop closer to the hard edge, it also tends to follow through a little bit more. And you can see it had, again, very decent follow through in spite of the fact that the signal itself printed very close to the outer edge of the trading band. Now, if you didn't feel good about it because you thought, well, maybe that's not that much of a retest, maybe the market's going to do a double pullback or something, I'll sit this one out. And at this point you're saying, oh no, why didn't I take the signal? Not to worry. You look for your cloud crossover signal, of which you had essentially a double pullback as well as a cloud crossover. So there's almost always another opportunity to get into a trade. So you shouldn't worry too much about missing trades. Like I say, you see me miss trades all the time. At least when you guys miss trades, nobody knows about it. Mine are up on YouTube. All right, so a nice little move there, and let's see, we maxed out the profit. Hooray! That's a very nice move. You know what? That's That's not easy to do on a single contract, and I'm not saying that to blow my own horn. You really need a cooperative market to get that kind of profit off of a single. And this market definitely cooperative, at least this morning. Yeah, see, way to go. Tony says I'm $5 short of my daily goal, trading only 2 contracts, so I'm not too upset. No, and you know, it's just another day at the office. All right, Paul's asking on crude oil. First micro macro cross. Now I think when you wrote that, it was probably still green bars. It's since turned yellow, so no, I would ignore it because of the yellow bars. But if it were a green bar still, let's dial this back here. So we're looking at this. We got a warning dot. We're going to pretend for a moment that, you know, the market's still green. It's trying to print a first micro macro cross signal. All right, class. So Paul is asking, is this a bear flag, or would you consider it a first micro macro cross? So Paul's looking at it like this. And he's thinking, is that just a great big bear flag? And the market's going to break down and head lower? Or is this a first micro macro cross, and should I trade it higher? All right, let's pretend that the signal actually printed, and we've got a complete signal now. So there's our, let's put our hash mark right there. All right, class, what do you think? Is this a bear flag, or is it a first micro macro cross that we should buy? I'll wait while you type. You can just write flag or XO or whatever you like. Okay, got one vote for a flag. Come on, I know there's more of you in the room here. Somebody just take a stab at it. That's a good learning opportunity. Okay, I got a vote for a crossover, a first micro macro cross. All right, I've got one saying when the trend is almost equal to the flag, I hold off. Okay, I got another first micro macro cross. All right. Well, it's a first micro macro cross. That we know. We're pretending now, of course, because you can see the warning dots and everything have disappeared. First micro macro cross is, of course, a high probability signal. Regardless of whether it finds itself in a bear flag or in some sort of sideways consolidation, it is a high probability signal, and therefore it deserves our attention. I keep saying in the trading room, I'll take them almost without exception. In fact, I'll point out the exception in a moment here so I don't make things too confusing. And why do I have an extra decimal place on my order? Okay, so it's a first micro macro cross order, so we're going to take the trade. Why? Because it's a first micro macro cross, and it's a high probability signal. So here again, it becomes a matter of logistics. It's not, do we take the trade? The answer is yes, we do take the trade. The question is, how do we set up this trade so that we can get to its profit objective? One way of doing it is we could, sorry, I need to reload my, see if my trade manager is working better now. No, I still got 3 decimal places. You see what's going on? I've got 3 decimal places on a market that should only have 2. All right, if your trade manager ever does that, you need to go to your strategies window and just delete it, put another one back on. This is why it's useful to have templates, because it saves a lot of time. There we go, that's better. Okay, so it's not a question of should we take the signal. The signal is yes, we should take the signal. Where do we cover the trade? Well, we could go to an ATR strategy perhaps, or any strategy really. I'm just picking on the ATRs. That might be a little bit cozy. Maybe roll it back a little bit more. So you could enter here and like this. And if you're comfortable with the risk amount, then you take the trade. If you're not comfortable with the risk amount, perhaps you can dial it down a little bit. Go in only for 1% of your capital. Oops, that looks like it's right on the cusp. There. So if this looks okay to you and you're prepared to walk away from $200, then you take the trade. If that seems a little bit cozy to you, because you're thinking, what if this is a bear flag? If this is a bear flag, then sometimes we'll see the market try to test the bottom end of the trend line. So you might be thinking, all right, well, maybe I'll set up my trade and cover down there. Okay, so you can afford the trade, you take it. Or here's your last option, you cover down here. Now, out of the 3 scenarios, this one has the highest probability of success. Why? Well, because we're giving the market all this room to move against us, and we're only looking for this as a profit objective. Assuming, of course, this is a first micro-macro cross. So it's not, again, not a question of, do I take the signal? It's a high probability signal. Yes, you take the signal. The question is, how do I set up the trade that I don't get stopped out prematurely? That's the question. Now let me show you an instance where I may not consider a first micro-macro cross to be a viable signal. And that's going to come in a situation, this is close, but not quite. It's going to come in a period of time when the market is moving very, very sideways. This is pretty close. We're going to pretend here for a moment because I'm not going to waste a lot of time looking for an ideal example. But let's say we had a first micro-macro cross signal print right here. Oops, wrong arrow. We had a first micro-macro cross signal print right here. This isn't one, we're only pretending. So we're going to pretend there's a signal there, and we're going to pretend there's a signal right here. Can anyone tell me why I might be suspicious of the first micro-macro cross signal or future first micro-macro cross signals? Why I might be suspicious about the next one that prints. So let's say the next one printed right there. Why would I be leery about taking this signal right here? Oh, you guys didn't know you were going to be back in school today, did you? Or perhaps this signal right here. If the blue circles here were first micro-macro cross signals, which they're not, but we're just using them as examples, why would that make me leery about future first micro-macro cross signals? Or I guess it would be more accurate to say follow-up first micro-macro cross. Yeah, okay. Good. I'm glad to see a few different names giving some answers. Excuse me. All right, so Tony suggests there's too many signals in a row. That's one thing for sure. Salish says there's buyers up there. Yeah, there's buyers down here. There's sellers up here. And Jim says it looks like a chop zone. You're all correct. What would make me leery is the failure. I know a first micro macro cross has about an 80% chance of being right. Actually, it's slightly better than 80% chance of hitting its profit objective. And yet this signal, I should have maybe drawn in where the signal engaged, but off this arrow, the signal engaged up here and promptly turned. Here, the signal engaged down here and promptly turned. So we're not getting any follow through on our first micro macro cross signals. No matter how deep our stops are here, we're getting stopped out. So when you have a high probability signal, a signal that's as high a probability as a first micro macro cross, and you're failing to get follow through, that tells you that there's something not right with the market that day. We're in a market, something's not going on. You know, we're producing high quality signals, but we're not getting the follow through. Therefore, we need to be a little bit leery. We need to be a little extra cautious. That would be the only time when I would be a little suspicious of a first micro macro cross. Now, this first micro macro cross, we're looking at the real signal now. This one, did it hit its high probability target? Yes, it did. All right, so that's all right. That's a viable signal. And then the next one that printed, this is also a first micro macro cross. Why? Well, because everything goes out of sync and comes back into sync. So the filter is out of sync, bar colors are out of sync, trend line is out of sync, and here we come back with a signal where everything is in sync. That's a first micro macro cross. However, this one engages, oops, sorry. They need to make that button a little bigger. So there's the signal. This one engages and then reverses. That's okay. The fact that the signal failed does not make me shy about taking the next first micro macro cross, which printed right here. Why? Well, because it may run 80% accurate, but that's not 100% accurate. Right? Every once in a while, you're going to take one that doesn't work out. So now here's the big test. We know it failed to the short side. A high probability signal failed to the short side. Mind you, after following through on the short side. Remember, this one worked out. This one failed. So if they're not working to the short side, we need to anticipate that they're going to work to the long side. Right? If they don't want to go down, it's a reasonable assumption to think they're going to go up. So if this signal had failed, it did not, it made its profit target quite easily. If this signal had failed, then it would be one of those situations where it's like, okay, what's going on here today? The market goes up, it turns, and comes down to try to stop me out. This is not a market that is behaving correctly. And this too tends to happen about once a quarter. So it's only going to happen to you about 3, maybe 4 times a year, but it's important that you're aware of it. There's going to be the odd day here and there where things are just not cooperating. You're looking at your high probability signals, you're not getting the follow through. Those are the kinds of days where you just say, all right, good day to go golfing or bowling or gardening or fishing or whatever it is you do, and just come back the next day. That's why it's also important to have a pain threshold, if you will, your safety net, where you say, okay, if I lose X amount of dollars today, that's it. I'm going to button up shop. I'm going to go home. For me personally, it's 5% of my capital. I figure if they clean me out for 5%, then I'm going to go home, or I'm not going to play anymore today. Interesting question from Christian here. Christian says, hello, Eric. I love the DTS system and I traded successfully with them, but in the last month there is a lot of hype for the market order flow for NinjaTrader, and it was pushing as a holy grail. What do you think about it, and will it also come into future for DTS? Yeah, it seems stuff seems to make the rounds, doesn't it? I'm hearing this a lot actually from a few owners. I've had at least 3 owners tell me now about the market order flow. Market order flow is helpful if you're scalping. In fact, a lot of people who scalp don't even look at a chart. They'll monitor the order flow. But in order to monitor the order flow, you actually have to have tier 2 data. So what you need is you need to open up what's called a dome. And I think I've got the wrong dome open. Hold on. You got the dynamic dome and the static dome. I'll show you what I'm doing. So here we go, dome. I think that's the one I want. I forget how to turn this thing on. Oh, there we go. Yes, all right. And the wrong contract one. All right, let's see what the advanced options are. Oh, that's nothing. So the thing with the dome, when this first when it was more commonplace, we would use this to buy and sell the market. So you would actually just place your orders on here. You would click an order, you could close your orders, and so on and so forth. The dome shows you the buying and selling relative to the current price. Right, so we can see at around 448.43 half, they're sitting around 200 orders. I forget, how do we center? Auto center. Oh, I probably broke it already. There we go. So you can see the buying and the selling. Now there's a thing called spoofing, where if you see abnormally large numbers on the extreme here, and I'm talking, you see that it's averaging around 200. If you see something like 800 orders pop up there, that's called spoofing. It's totally illegal. It doesn't mean nobody does it. And what they're trying to do is they're trying to fool the trading computers into thinking there's a lot of sell orders up here. And because of that, the market will tend to to move lower. That doesn't happen all that often, but just thought I'd point it out while we have it on here. In order to be accurate with market order flow, at least from a scalper's perspective, you need what's called Tier 2 data. This is, first tier is right here. You can actually get a second tier printing. And a lot of people aren't even aware that there's Tier 2 data out there. But there is, and it's that's really what the scalpers are watching. They're watching the Tier 2 data, and what they're watching for is whether the orders are disappearing, whether the market is chewing through the orders on one side or the other. Well, guess what? We already have a tool that does that. And I think it's easier to watch than the market order flow, and that's the Geiger counter. Now, admittedly, the Geiger counter only shows Tier 1 data, but it essentially gives you the same kind of information, where when we see this dial pull hard over and stick one way or the other, see how it's sticking now to the short side, we can anticipate a short-term move lower, providing it doesn't come back and stick here to the buy side, which is exactly what it's doing. So we've got a market that's fairly balanced right now. So I think from a scalper's perspective, order flow is perhaps more useful because it will tell you short-term bias. It will not tell you long-term bias. All right, so you see how it's sticking here? Let's see whether we get a little short-term move lower now. So the scalpers are watching order flow. The markets are chewing through the short side. The scalpers are saying, all right, we'll short at market. And they're just looking for a scalp target, right? So they're not looking for anything big. They're looking for a $50 target, get in, get out, and that's what they do with order flow. Personally, I don't think order flow is that useful. I tend to gravitate toward probabilities. So I much prefer to find a high probability signal and then look for some follow through from that signal. At least enough follow through to hit my high probability target. So I think the order flow may be gaining popularity because of all the HFT trading and how everybody thinks that's the, the only way to trade now. No, some of the best traders I know look at weekly charts and trade off those. Actually, I even know another trader who doesn't even look at a chart. She just analyzes the price. She just looks at the price. If it looks like a buy, she buys. If it looks like a sell, she sells. All right, so you see how they're sticking now to the buy side. So that tells me that this move to the short side that we were anticipating is probably going to be short-lived. And if I'm running, I don't have a stop in here, but we should hit the profit target here in a second. Come on. There we go. So now we saw them chewing through the buy side. Oh, maybe not. The sellers have come back. See, I consider order flow a little bit too subjective as well. You're always watching, trying to gauge who's gaining the upper hand. But no, Christian, to answer your question, I wouldn't be too concerned about it. There's so many ways to trade. So many ways. I think what's important, we've all been to that point where we're totally signal obsessed. And I know because I was once this way as well, where you're looking at your trades and you're doing well, and then all of a sudden you hit a losing streak. And what do? Well, you throw the baby out with the bathwater and you redesign your entry signal to try to factor in those losing signals. rather than realizing your signal is still okay, but the underlying market conditions have changed. That's why with DTS we have three tools. We have scalping, swing trading, and trend trading, because that encompasses the whole enchilada, as they say. But what most traders do is they get caught on that hamster wheel of trying to find that perfect indicator, that perfect setting for, their stochastics or RSI or MACD or whatever it is they're following, and they fail to realize that successful trading is like a three-legged stool. Yes, an entry signal is important. That's one of the legs. But you also need to have a way to manage the position, and you have to have money management. You cannot trade successfully without all three. It's just how it is. Yeah, like Steven says, most of the bid and asks are fake anyway. It's especially with computers running so much of the market nowadays. You know there's programmers out there trying to fool the other trader's computer into thinking one thing. They're trying to convince the competitor's computer to sell the market so they can buy the market. It's silly. Yeah, I agree, Christian. Christian says, I think I'll forget the order flow and just trade DTS. Good point here from Salish as well. You could be right. He's mentioning that the NASDAQ may not have enough volume to follow the order flow correctly. That's true. A lot of people who trade that way will gravitate toward the E-mini S&P because, of course, it's huge. All right, we're seeing a little bit of a retrace here. During my little rant there, we had a first micro macro cross lower, which, given the very large uptrend that we saw this morning, I'm not sure we're going to see a full-on reversal, but we could see prices dip a little bit lower. If I had a chance to take that one, I would definitely be all in, all out. I would just grab the profit when I had it. Thank you very much. I would not try to run a short position. Here on the Falcon, we also had a trend change signal / late filter entry. So the late filter entry occurs when the filter goes out of sync, comes back into sync. The trend line never changes color. And we're making our way toward our profit objective there as well. I can see the market falling back here to the primary support line. Wow, really? That could be why we rallied so hard too. Look at how deep we were into the support zones. We were 3 zones deep. Rallied back to the median line. Took a little bit of a late rejection, but now I can see the market trying to get back here to the primary support. And on the Raptor, we had another soft edge sell. So we had 2 chances at this. We had the soft edge sell right here and a follow-up signal right here. Once again, you need to have a trend. and then you need to have the failure before the signal. So you could count that as a failure. You could count failure. And our target is the hard edge. And because this is counter trend after a rather substantially bullish morning, it may be good to take profit if you get it down there. You should have hit your break-even trigger if you're running one. So that'll take a little bit of heat off the trade. Soybeans trickling lower this morning. So a nice little late filter entry signal there for soybeans. Also happens to be the trend change signal. And they are almost to their profit target. So after that rather strong rally, where we took out that little swing, we can normally anticipate two moves in the direction of the breakout. This is a little bit tough to judge. Some people are going to count that as move number one, and this is move number two. And other traders are just going to see this whole thing as move number one. They may actually even choose this as the breakout point. So if that's the case, we might see one more push higher here before the end of the day. I don't know if we're going to see it necessarily during this morning session. And the Falcon just flirting with the support zone, and the Raptor almost trickled down here to the hard edge, where we will probably see some sort of reaction. everything's gotten quiet now, I have a feeling that could be the move of the day. Yeah, everybody's falling asleep again. We had that couple clear signals, and now we're kind of stuck. This would be my day, though, you know, to grab a move like that, to pull that off on a single contract. That would be my day. I wouldn't press my luck. My only regret is not trading a double. All right, and looking at the Geiger counter here, it looks like we're getting the orders, some buying coming into the market here. So if you are short on this, you're probably going to want to run a tighter stop. Or at the very least, get your trade to break even. There could be a little bit of an uptick here. Like I said, given this huge move that we've seen, we should probably anticipate one more move higher today. I don't think that would be at all unreasonable. Well, things are continuing to move sideways here, as we might well expect. I think we may close up the room a few minutes early here. I've got to run out. I've got a meeting with my accountant this morning. Ooh, doesn't that sound like fun? And, well, we'll do this all again tomorrow. Hopefully the markets will be just as cooperative as they were today. A reminder that tomorrow, Wednesday, we are meeting at the alternate venue, which is the free trading room. If you don't already have access to that, you can email Adam, and I'll give you his email, adam@indicatorwarehouse.com, or simply go to the indicatorwarehouse.com website and sign up for the free trading room. All right, we will see you again tomorrow morning. Bye for now.